Hi, and welcome to the My SG Prop podcast, where we explore smart property investing and uncover insights from Singapore to the region. I'm Rini, and today, CS, we're diving deep into something really interesting: Singapore's executive condominium, or EC, market. It's an educational episode, so we'll be giving you all the detailed explanations, tips, examples, and even some case studies.
That's right, Rainey. And it's a topic that's often misunderstood, isn't it? Many people just see ECs as, well, just another kind of condo. But it's actually a uniquely Singaporean asset class, quite strategically engineered by our government. It's not just a housing option. It's a policy-driven pathway into private property ownership, designed with very specific economic and social goals in mind.
Policy-driven, you say? That makes it sound a bit more complex than just buying a new home. So, what exactly is the strategic rationale behind ECs then? What's the government's big idea here?
Well, at its core, the EC is a hybrid property class. Think of it as blending the affordability of public housing, like an HDB flat, with all the lovely design, amenities, and lifestyle you'd get from a private condominium. It's primarily designed to help what we call the sandwich class.
Ah, the sandwich class. I've heard that term before. Is that for people who earn too much for HDB but still find private condos just out of reach financially? My cousin, for example, always talks about being in that exact spot.
That's exactly it, Rainey. Their incomes are too high to qualify for new HDB flats, but fully private condominiums are prohibitively expensive for them. So the EC acts as a regulated gateway for this specific demographic to access private homeownership. They're developed by private developers, come with swimming pools, gyms, clubhouses, all the usual private condo facilities. But here's the catch, and the key to its value. They're subject to HDB regulations for the first 10 years, even though they're 99-year leasehold. This hybrid status is really the cornerstone of their value proposition.
So it's like getting the best of both worlds, but with some rules attached. I see. Now, for the quantitative side, how much of a subsidized entry point are we talking about? Is there a significant price gap compared to private condos?
Absolutely, that's where the core financial benefit really shines through. New ECs are typically priced 20% to 35% lower than comparable private condominiums at launch, thanks to those government land subsidies. The immediate equity advantage for buyers is substantial. If you look at market data, say, a new EC in Tengah might be around 1,500 Singapore dollars per square foot, whereas a new private condo in the outside central region, or OCR, could easily be 2,000 Singapore dollars to 2,300 Singapore dollars per square foot.
Wow, that's quite a difference. So you're saying there's an instant gain just from the point of purchase?
Precisely. And what's even more interesting is that this price gap has actually widened. Back in late 2021, the median price gap between a new EC and a new non-landed private home in the OCR was around 388 Singapore dollars per square foot. Fast forward to 2025, and it's jumped to 700 Singapore dollars to 900 Singapore dollars per square foot. This widening gap, largely driven by the rapid price appreciation in the private market, significantly enhances the intrinsic investment appeal of ECs. It creates a larger potential margin for future capital growth, which is brilliant.
That's fascinating. So you buy it cheaper, and the gap itself is growing. But you mentioned HDB regulations for 10 years. How does that affect the investment trajectory? Are there specific milestones that unlock value?
Yes, there are two crucial regulatory milestones that act as predictable catalysts for value unlocking and capital appreciation. First, after completion, EC owners must fulfill a 5-year minimum occupation period, or MOP. During this time, you have to physically live in the unit. Once that MOP is fulfilled, the EC enters a semi-private stage. At this point, it can be sold on the open market, but only to Singapore citizens and permanent residents. Interestingly, data shows that the highest average rate of return for ECs often occurs in the 0 to 1 year window immediately following the MOP, mainly because there's a surge in demand meeting a limited supply of newly available resale units.
So the demand really spikes once it hits that 5-year mark and can be resold. What about after that? What's the second milestone?
The second, and perhaps even more significant milestone, is the 10-year privatization mark. After 10 years from its completion date, the EC becomes a fully private condominium. All HDB ownership restrictions are completely lifted. This means the property can then be sold to all buyers, including foreigners and corporate entities. This expansion of the addressable market dramatically enhances liquidity and supports further price discovery. So you can see how these milestones are essentially built-in value catalysts.
That's really clever, how the government has structured it to appreciate in stages. But all these benefits sound like they come with some pretty strict rules, right? What are the regulatory gates for accessing the EC market? I imagine not everyone qualifies for this sweet deal.
You're absolutely right, Rainey. The value proposition of an EC is intrinsically tied to its regulatory framework. These strict eligibility criteria, while restrictive, are precisely what preserve the asset's subsidized value. They manage demand, prevent speculation, and ensure the scheme serves its intended demographic. Understanding these rules isn't just about compliance, it's a strategic imperative.
So, what are the core eligibility criteria for new ECs then? Who can actually apply?
To purchase a new EC directly from a developer, applicants must meet a set of primary HDB requirements. These revolve around forming a family unit, citizenship status, and age. You need to qualify under an established HDB scheme, like the public scheme for married couples or parent-child units, or the fiancé/fiancée scheme. For citizenship, at least one applicant must be a Singapore citizen, and the CO applicant must be either a Singapore citizen or a Singapore permanent resident. And everyone must be at least 21 years old, or 35 for those applying under the joint single scheme, where both applicants must be Singapore citizens.
Right, so it's quite specific. No single individuals applying alone unless it's a joint single scheme at 35. And then there are financial gatekeepers, I assume? Like an income ceiling?
Indeed. Two key financial gatekeepers strictly define the target sandwich class demographic. First, the income ceiling. Your gross monthly household income, for everyone listed in the application, must not exceed 16,000 Singapore dollars. To align with the current price point of EC, potentially government might relax the income ceiling level. For salaried employees, this is usually based on the average income over the last few months, excluding bonuses or occasional overtime. Second, property ownership. Applicants must not own any other property, locally or overseas, at the time of application. And, if any applicant has previously owned private property, they must have disposed of it at least 30 months before submitting the EC application.
So strict on income and no other properties. It really is for a specific group of people. What about later in the EC's life cycle? Do the eligibility rules change if someone wants to buy a resale EC?
Yes, they certainly do, and this evolution is key to the asset's liquidity. For new ECs, from years 0 to 5, strict HDB rules apply to Singapore citizen households, meeting the income and ownership criteria. But, from year 5 to 10, when it becomes a resale EC, the pool of eligible buyers expands to Singapore citizens and permanent residents only, and here's the good news, there are no income ceiling or HDB property ownership restrictions. Then, after the 10-year privatization mark, it's completely open to all buyers, including foreigners. At that stage, standard private property rules apply, with no HDB restrictions at all.
That's a huge shift in market accessibility. It really shows how the value is unlocked over time. Now, once you've navigated all these rules and criteria, the next big hurdle is usually the financing. How do the financial mechanics of acquiring an EC differ from, say, a regular HDB or private condo?
Well, for financing purposes, purchasing an EC is treated as a private property transaction, but with a few crucial regulatory controls. First, you absolutely must finance it with a bank loan. HDB loans are not available for ECs. The maximum loan-to value, or LTV ratio for a bank loan, is 75%, which means you need a minimum down payment of 25%. Of that 25%, at least 5% must be paid in cash, and the remaining 20% can come from either cash or your CPF ordinary account savings.
Okay, so it's a bank loan, 75% LTV, and a significant cash portion. That sounds similar to a private condo, but are there any additional debt servicing rules?
Yes, there are. EC buyers must comply with 2 debt servicing ratios. The total debt servicing ratio, TDSR, caps your total monthly debt obligations at 55% of your gross monthly income. But here's the crucial part. During the 5-year MOP, the stricter mortgage servicing ratio, MSR, also applies. This limits your monthly mortgage repayment for the EC to just 30% of your gross monthly income. The MSR is typically reserved for public housing, so layering it on top of the TDSR for ECs is a prudential measure to ensure financial prudence for buyers of these subsidized assets. It can be quite tight for some.
That MSR during the MOP really does make you think about your finances carefully. I suppose developers offer different payment schemes too, to help manage cash flow?
They do. Developers typically offer 2 strategic payment schemes, the normal payment scheme, or NPS, and the deferred payment scheme, DPS. With NPS, you make progressive payments at various stages of construction, tied to milestones like foundation and framework completion. This is good if you're comfortable servicing your mortgage as the property is being built.
And the DPS? That sounds like it might be good for HDB upgraders, perhaps?
Precisely. The DPS is primarily designed for HDB upgraders who need to sell their existing flat to fund the EC purchase. With DPS, you make an initial 20% down payment and the remaining 80% is deferred until the project receives its temporary occupation permit, or TOP. This allows upgraders to avoid servicing two housing loans simultaneously and obviates the need for a bridging loan. The trade-off, however, is that the unit price is typically about 3% higher with DPS to compensate the developer for the delayed payment and financial risk.
That makes a lot of sense. For HDB upgraders, it gives them more flexibility. And what about government subsidies? Are there any grants available for EC buyers?
Yes, there are. Eligible first-timer households can receive a CPF housing grant, or CHG, of up to 30,000 Singapore dollars to offset the purchase price. The grant amount is tiered based on household income. 30,000 Singapore dollars for household incomes up to 10,000 Singapore dollars, 20,000 Singapore dollars for 10,001 Singapore dollars to 11,000 Singapore dollars, and 10,000 Singapore dollars for 11,001 Singapore dollars to 12,000 Singapore dollars. However, for second-timer applicants, those who've previously purchased a subsidized HDB flat, they're liable to pay a resale levy. This is a fixed amount. For example, 40,000 Singapore dollars for a previous four-room flat and 50,000 Singapore dollars for an executive flat.
So, grants for first-timers, but a levy if you've already benefited from a subsidized HDB. It's a balanced approach. Now, let's talk about the exciting part, performance analysis and exit strategies. For those who do go through all this, how well do ECs actually perform as an investment?
Historically, Rainey, the EC market has a strong track record of generating significant capital gains for owners. On average, EC sellers realize a gross profit of approximately 314,000 Singapore dollars. Historically, post-MEP gross gains have often ranged from 300,000 Singapore dollars to 1 million Singapore dollars, depending on location, layout, and market cycle. Some exceptional units have even netted over 1 million Singapore dollars.
1 million Singapore dollars? That's incredible. Can you give us a few examples of some of these gains?
Certainly. Based on URA caveats from 2024 to 2025, we've seen developments like INZ Residence with estimated gains of about 1.1 million Singapore dollars, or plus 87%. 100 Palms Residences also saw around 1.07 million Singapore dollars, a plus 134% gain. The Brownstone, about 706,000 Singapore dollars, or plus 95%, and Treasure Crest, about 1.04 million Singapore dollars, which is plus 107%. These are fantastic returns, though of course final outcomes depend on unit-specific attributes and market timing.
Those are some seriously impressive numbers. It really highlights the potential. So if someone is looking to sell, is there an optimal time to exit, or does it vary a lot?
Research into EC resale transactions reveals a distinct lifecycle pattern for optimal exit timing. We often see peak profitability in the 0 to 1 year post-MOP window. A significant 40.5% of all post-MOP sales occur within this period, delivering an average simple rate of return of 5.74% and a peak compounded annual growth rate of 4.87%. This is due to that pent-up demand meeting newly available, limited supply we discussed earlier.
So getting in quickly after the MOP is key for the highest returns. What happens if you hold on to it longer?
Following that initial peak, the rate of return remains relatively consistent for the next 1 to 7 years post-MOP, indicating stable but less dramatic price appreciation. This period often includes a secondary peak in profitability around the 5 to 7 year mark, which aligns with the EC approaching full privatization. However, after the 10-year privatization mark, from around 10 to 15 years post-MOP, the rate of appreciation tends to slow. This can be attributed to the EC's increasing age and growing competition from newer private and EC developments. But, interestingly, in the long term, around 17-plus years post-MOP, older ECs often experience a rebound in returns, driven by broader market appreciation, inflation, and the asset's now established location and surrounding infrastructure.
That's a really nuanced trajectory. It sounds like you need to be quite strategic with your exit timing to maximize gains. And speaking of strategy, once the MOP is fulfilled, what are the different strategic pathways EC owners can take? Is it just about selling?
Not at all. It's about asking, what do I want this property to do for me next? Stability, liquidity, or growth? Owners have several strategic pathways. One common path is to upgrade, sell the EC, and then buy a private condo. By selling the EC first, the owner technically owns no other property, allowing them to acquire the new private condominium without incurring the additional buyer stamp duty, or ABSD.
That's a smart way to avoid ABSD. What are some other options?
Another is to cash out, sell the EC, and buy an HDB. This strategy unlocks the built-up equity, which can then be used to purchase a more manageable HDB flat with the remaining cash proceeds freed up for savings, investments, or other financial goals. Then there's an advanced strategy for couples called asset splitting, or the sell one, buy two strategy. After selling the EC, the couple can use the combined proceeds for each spouse to purchase a separate private property under their own name. If sequenced correctly, both purchases can qualify as a first property, thus avoiding ABSD on both units.
Sell one, buy two. That sounds incredibly strategic for growing a property portfolio. And what if they want to keep the EC and still buy another property?
For households that wish to keep the EC while acquiring a second property, decoupling is an option. This legal process involves one spouse buying over the other's share in the EC, resulting in sole ownership for one. The selling spouse's name is then freed up to purchase another property without incurring ABSD. As you can see, the strong performance and strategic flexibility of the EC asset class truly underscore its unique position within the broader Singapore property market.
Wow, so many possibilities once you've fulfilled your MOP. It's not just a straightforward sale. So CS, to wrap things up, what's your final verdict on ECs? How do they really stack up against private condominiums when we look at them side by side?
Well, Rainey, the executive condominium, as we've discussed, is a government-calibrated investment vehicle. Its regulatory restrictions are explicitly linked to predictable financial outcomes. It's engineered to provide a subsidized, high-potential entry point into Singapore's private property market for a targeted demographic.
So it's a strategic trade-off then? What are the key differences?
Exactly. The entry price for an EC is 2,035% lower due to subsidies, while private condos are market-driven and significantly higher. Eligibility for ECs is restricted by income, citizenship, and ownership rules, whereas private condos have no such restrictions. For financing, ECs are subject to a stricter 30% MSR during MOP on top of the TDSR, while private condos only have the TDSR. ECs are eligible for CPF housing grants, private condos are not. Capital appreciation in ECs has structured value jumps post-MOP and at the 10-year privatization mark, while private condos are driven more by location, market cycles, and project attributes.
And exit flexibility is a big one, right?
Yes, ECs are restricted for the first 10 years, with the MOP and then sales restricted to SCPRs only from years 510. Private condos, however, have high liquidity and can be sold to anyone at any time, subject to seller's stamp duty. Lastly, ECs are mostly in non-mature or fringe locations for affordability, whereas private condos are available across all regions, including prime central districts.
That really lays it all out, CS. It's clear that for the qualified sandwich class investor with a long-term horizon, the EC isn't just a home, but a disciplined and structured wealth-building instrument. It's a strategic choice, not just a housing type.
Precisely, Rainey. It's about understanding those trade-offs and leveraging the inherent advantages.
That's all for today's podcast from My SG Prop. I hope you picked up something useful for your next property move, especially if you're in that sandwich class. Don't forget to follow or share this episode with someone who's into real estate too.